Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 8th of 2021. Please see our disclaimer for important information. Well, as we get started this week in our chart back, we revisit our COVID tracker, which is data from the CDC, as reported to us by our friends up in Chicago, First Trust Advisors. As you can see here, the trend line and the 7-day moving average for daily new positives as well as daily deaths continues to follow a pattern that we saw develop in September as the Delta variant began to wane in terms of its spread, and we're now seeing a rather protracted contraction, if you will, in case spread as well as fatality rates. So as we head into the winter months and the colder months of the year, we will obviously monitor other variants that might emerge or whatnot. Typically colder months portend more indoor activity, and in any case, there's really nothing on the near-term horizon right now, but we'll watch the news wires there. But the data on balance remains very positive. Here's our high-frequency data, again from First Trust, and I truncated the far right columns, which give us the week-over-week and month-over-month data, and that data can be rather noisy. What I really want to focus on right now is the change relative to 2019 on some of these key indicators. And we've been watching this data for a while, and sometimes we get caught up in the weekly trends, and we know that the environment's been improving, but I really wanted to kind of give you all a kind of a checkpoint of where we are relative to the pre-pandemic level. So just kind of scatter shooting here. Obviously, TSA checkpoint data and commercial flights down around 18-19% from their pre-pandemic levels. Open table, restaurant activity, even though we have a lot of labor issues and a lot of restaurants are operating at limited capacity, we do see that activity is only about 10% below its pre-pandemic level. So very positive there. Hotel occupancy down about 6% in terms of occupancy rates. Again, we're regaining some ground, and in some cases with some fits and starts, but on balance, we are regaining ground. And in a lot of areas, we're really not that far below where we were pre-pandemic. You see rail car traffic pretty much flat, steel production down slightly, but that number's been positive, on various weeks, and we have had a lot of durable goods orders. Manufacturing has been fairly strong, so that number rebounded actually fairly quickly. It's kind of held in there. And then as you can see here in the shaded area, in terms of our labor market, we've recovered tremendously. So the 269,000 initial jobless claims in the last reading is essentially now at a high level post recovery, so you see continuing jobless claims. Those numbers are down considerably as well. Weekly retail sales, again, all trending in the right direction. Here are some charts regarding the high frequency data. You can see this in more visual terms here. Open table restaurant activity, again, tracking fairly strongly here. And we did see a little bit of a dip when Delta kind of had its heyday. Those numbers are improving. TSA checkpoint data, you can see where we are relative to that gray line in 2019. And then supply of motor gasoline in the U.S. And that's obviously an emerging story because we've got driving. We have increased fuel demand. We have limited supply and production numbers coming out of the crude market, and that is putting a kind of a price floor underneath crude, which is obviously creating price increases for all the distillate products. And then commercial flights, you can see that number as well. So we've been monitoring the real estate market, and so this is the housing price index. And this is from CoreLogic, and so the key takeaway here, and we've had an incredibly robust residential real estate market, and we know prices have gone up by a tremendous amount, and this is really the first sign that I've seen kind of looking into 2022 where CoreLogic is looking for price gains, but they're only looking for about 2%. So what we saw in 2021 is, at least by CoreLogic's definition, not likely to reoccur, if you will. And so we'll have price gains, but at this point, at least if you believe the CoreLogic data, then we're going to have a price gain environment that is actually not going to exceed inflation, which will be very interesting for a lot of different things, not the least of which is going to be, rents within the consumer price index and other second order impacts. Here's a chart from CoStar on mall retail space in the United States. As you can see here in the black line, available square footage really bumped up high during the pandemic and remains elevated. And I think this is going to be something that we'll be watching for years to come. And the argument is that you're going to have more online demand, more electronic purchasing, less in terms of mall traffic and physical transactions amongst humans. But we do have a lot of outstanding mall space. We do have rent growth in malls right now, which is kind of intriguing given the fact that we've got an increase in vacancies. But this is something that's going to take years to shake out, and I can see malls being repurposed into other types of structure and other types of uses. But right now we know that there's a lot of dislocation in the large footprint retail space. Another chart that I saw in a recent RSM publication, and this is really emblematic of the rapid increase post-pandemic of retirees from the workforce. So this is a chart basically plotting the labor force not in the population 55 and over, and we've seen a really big spike in the pandemic, and those numbers remain high. So these are people that have removed themselves from the workforce that have helped to exacerbate, in many respects, the labor choke points that we're finding in many parts of the economy right now. Average firm by size of number of employees. I thought this was interesting because the critique and the analysis that we've been making over the long haul here during the pandemic, and as the pandemic is on its wane, is the impact on small businesses. And we find here that data provided to us by the Census Bureau has really indicated over a number of years that companies are we're finding greater consolidation amongst businesses, and so average firm size by number of employees has been trending higher really ever since the emergence from the global financial crisis. And if anything, I'd say maybe the last 12 to 18 months has perhaps perpetuated that trend as small businesses have struggled. But what I thought was that it would accelerate a trend of consolidation. But what I find in this data from the Census Bureau is it's actually been taking place over a number of years already. This is a quick look at the ISM Institute for Supply Management Services Purchasing Manager Index. So there's a lot of data there, and you can see the ISM Services PMI, the index reading itself is 60, almost 67. And as you've heard me say below, this is this is a diffusion index. So anything above 50 represents expansion, and anything above 60 represents really strong expansion, which is essentially where we are now. So in fact, this number is a record high that we've seen. So that's very positive. This is a very representative of the emergence of the service sector. We saw manufacturing kind of lead the way out of the pandemic, and services is really gaining steam right now. So, and in the notes on the right-hand margin, you can see, obviously prices paid are moving higher, orders are really strong, delivery lead times are also extending strong, but the demand is there. And so inventory sentiment is pretty low, and that just represents the fact that inventories are really thin right now. You just have to go to your retailer or your auto dealer and and you'll certainly know what I'm talking about there. But employment is a little bit checkered right now, as we know, but it does remain in expansionary territory. So bottom line here is the services sector is in really good shape right now. Here's a quick note on trade. So we see the trade balance, and if you back out petroleum, which can be a little volatile, you can see that the trade balance is really gone south. And this is not, again, if you look at this data series going back to 2002, it's not something that's happened overnight. It's certainly not something that's happened during the pandemic. I mean, these trends were already well entrenched. And what does this number really represent is that we're obviously importing more than we're exporting. Import demand, as we know, accelerated during the pandemic at a time where trade really kind of clogged up. And so you can see that the downward trend accelerated during the pandemic and remains really low right now. So import demand is exceptionally high. In fact, you can see that the degree to which that number has dropped is really a function of this huge rapid increase in demand. And in fact, this type of number, can really shows you why we're having the supply chain bottlenecks that we are, because demand for imported goods has really spiked up at a time where the supply chain has really struggled to keep up with it. If we look at commodity exports to China, a lot of people spend a lot of time on this bilateral trade with China, and of course we have tariffs on a lot of goods, but this is commodity exports to China. And so what we've seen here is a rather dramatic decrease after being stronger earlier in the year. And so you look at what this basket represents, and it's some of the agricultural commodities, corn, cotton, soybeans, etc. And we're heading into a period where we typically see much higher numbers in terms of export volumes. We're just not seeing that right now. China is a little bit having some economic headwinds, if you will, certainly relative to China. In the aggregate, they're certainly growing a lot faster than many other parts of the world. But at least from China's perspective, they are definitely slowing down. So this number is helping to exacerbate that trade number that I showed you in the previous chart. So this is the Baltic Dry Index. And so what is the Baltic Dry Index? And so, this is really bulk commodities when you think about it. It's not container ships, it's bulk commodities. And, with the slowdown in China, in some of the other parts of the Asian Rim, it has really helped to contribute to what is very ironically, as we see, 40 some odd container ships parked off the port of Long Beach, and all of these supply chain choke points, where prices on container shipping have really soared through the roof. The irony is on bulk goods, bulk commodities, we've seen a rather dramatic decrease here as of late. Some of it has to do with what I showed you in the previous slide with regard to shipments to China, but it is a kind of a worldwide phenomenon right now. All right, supply chain. A quick update here. I'd say conditions haven't gotten any better. Have they gotten worse? Perhaps a little bit, but the read-through on this is that the supply chain choke points are not likely to resolve themselves anytime soon. This is from Oxford Economics, and it shows you kind of by their analysis, what the component inputs are to what they're calling their stress tracker. And so prices are high. Now, these relate not only to goods prices, but also to shipment prices. But you see that, everything's participating here. Labor is more expensive. That's an input. Transportation is definitely an input. And activity levels are high, and we have these choke points. And so it's creating a lot of stress in the supply chain right now. And one particular element of the supply chain choke points that has been often discussed is the global semiconductor market. And so, You can see in this chart from market economics and data provided by MRB partners that you can see here that sales are very high, but lead times are extremely long. And you can see down below you've got semiconductor sales year over year. That number, if you look at aggregate sales, they're obviously moving higher. If you look at perhaps year over year semiconductor sales, the rate of gain appears to be slowing somewhat. The manufacturing PMI index, even though it remains extremely strong, it's definitely in expansion territory, it's just decelerating a little bit. And I think, what this chart is trying to indicate is while semiconductor sales are strong, growth is likely to slow. Again, positive, but just slower than it has been as of late. All right, continuing this theme of supply chain, if you will, you've got basically truckload freight prices continue to remain high. And this is one of the big issues with regard to the supply chain issue, right? Because you've got all these ships, container ships off the major ports that are at anchor waiting to be unloaded. The problem is you don't have enough drivers and enough basically, LTL, less than truckload, or less than full truckloads, and overland transportation has really been a choke point as of late. You can see on the right-hand side, that kind of graphically depicted here in terms of long distance freight is really troubled right now because of a shortage of drivers. And as a result of the supply chain choke points, particularly with regard to container freight, you see a lot more people using air cargo, and it's a lot more expensive to ship by air. But you can see here that in the pandemic, when things began to bottleneck, that you saw a rather dramatic increase in the Evercore ISI survey here for air cargo volume. All right, and continuing this theme of the services sector emerging, this is kind of a breakdown of the ISM number that we talked about a few slides ago. So this is on the upper left-hand corner, it's a Services Purchasing Managers Index. We just saw this in a slide, but I wanted to drill down a little bit more and just kind of bring us up to speed on where the components lie within this survey. So we know that the PMI itself is at a record level, very high, almost 67. If we go down from the upper left to the lower left, you see new orders. Again, those are really strong, very, very strong numbers going back to the beginning of this century, and very kind of emblematic of an expansion economy environment. So, but on the other hand, you see under supplier deliveries, we see that those lead times are really extending. They're exceptionally high right now, and a backlog of orders. So while this is good for the long term, it's good for inventory levels, which inventory is a part of the GDP or the economic growth calculation. I think this definitely is a net positive for future growth. It's just pushing that growth off into the future. And as you can see, the magnitude of the change of these numbers, it would seem to indicate that it's just going to take a while to get that through the system. So a quick look at the employment index with regard to services. And so I wanted to show this and a couple of pieces here that are really influential into what will eventually become the inflation basket, right? So within the services sector, which again, it accounts for a bigger chunk of our economy than does the manufacturing sector. I mean, it far outweighs manufacturing, but you can see the supplier deliveries index remains high, employment index remains muted, if not trending a little bit lower right now. So, I mean, this is really the story of the economy right now. Orders are strong, lead times are exceptionally long, and labor is really tough. As you can see on the right-hand side, this is the conundrum facing service providers right now, is that the prices paid for these types of inputs. particularly labor. Labor is very important in the service sector, and you can see overall prices paid continue to trend much higher. Switching gears for a second, I wanted to show you this from some other research from the Daily Shot, and it's OPEC production and quota levels. And as we sit here and talk about the volatility in energy prices, in particular crude prices, we talk about gasoline. Gasoline prices being higher is a huge psychological influence on consumer behavior when they're having to pay prices at the pump that far exceed what they did even 2 months ago. That's definitely impactful. But as we kind of back up and take it to another derivative level, you can see here that in the black line, these represent quotas for OPEC. And we know OPEC still matters. Obviously, the U.S. is exporting some crude and certainly producing a lot more than it did, even though it's not producing, U.S. isn't producing anywhere near what it used to pre-pandemic. But you can see here that we're not, even actual production is falling behind the quota levels, and Saudi Arabia is very influential in the overall OPEC number. And I think what this tells us is that we should remain somewhat bullish, at least over the near term, on crude prices, and that's going to translate into some higher overall gasoline and other distillate prices. So here's a quick look on gasoline inventories, and this is more input into this function of why I think we're going to have higher gasoline prices at the pump for a while, and again, why I think we're going to have essentially higher oil prices for a while, and it's going to help oil producers. We've already seen that in some of the earnings reports, where higher prices have clearly benefited them in quarterly earnings reports. But you can see here on the left-hand side, days of supply of gasoline, and looking at a composite of several years worth of data here, and you can see that we're at the lower boundary of that. So supplies are very low, and you can see demand on the right-hand side is very high, at the top end of its kind of trend line or cohort, if you will. And so this is just a perfect recipe for higher overall gasoline prices for the foreseeable future. And I was watching a Dallas Fed, actually a joint Dallas and Kansas City Fed energy symposium last week, and they got pretty heavily into clean tech and alternative energy sources, looking out into the long term, and long term here is defined by 20 to 30 years. And I thought there was a couple of slides that were really poignant to me. So as much as has been discussed already about alternative energy supplies for, say, vehicles and other items that were typically supported through combustion engine technology, you can see that this trend line here going out, each decade over the next several decades, a huge influence in terms of battery, in battery technology, battery packs. Wind will continue to be relevant. I think over the next 10 years, they're expecting wind to be much more of a factor in terms of being able to deliver energy into the energy markets and being impactful in terms of production levels overall. And then you also see fuel cells begin to emerge as a real driver of energy, as an energy source, if you will. So another representation of this trend line that we saw on the prior chart. So 2019, oil represented, essentially as a value of international trade that's tied to energy. The oil was 2/3 of that, and you can see, as you go out to 2050, under the current environmental constructs that are out there, that oil, as an influencer will decrease. Now, if you get to a net zero, and a lot of people are talking about that, and obviously COP26 there's a lot of discussion with regard to a shift to environmentally friendly technologies, that you see here that oil under that construct goes down quite a bit, and you see critical minerals and hydrogen really emerge as like an alternative source there. So we'll pivot now to the labor markets, and I'd say the best way to look at labor right now, essentially the takeaway that I can give you is that labor is tight, especially amongst the service levels, especially amongst kind of the lower and semi-skilled areas of the market, the hourly workers. Very, very, very tough to fill a lot of those positions right now. But if you look in the aggregate at the labor market, left-hand side, you see initial jobless claims. You can see us trending down towards the lower boundary of this multi-year, essentially the last decade's worth of data here. And it's at the lower boundary of that. On the right-hand side, you can see continuing claims for unemployment continue to decrease, if you will, with far less influence from the pandemic assistance programs, some of these special programs tied to the pandemic, and you see this continuing downtrend. Again, all signs pointing to an increasing health of the labor economy. Unemployment duration of 27 weeks or longer. This is long-term unemployment. Again, more evidence here that the labor market is improving, although we do have we have an extremely high quit rate, which is creating a lot of stress amongst the service sectors we've been talking about. But if you look at long duration or long-term unemployment, those numbers are clearly coming down. As we continue to talk about inflation and some of the inputs here, I mean, obviously wages are important, rents are the other thing that are very important, but one of the things that can help dampen inflationary pressures is productivity. Of course, when you have some slowing, interim slowing in the economic data, it tends to dampen the benefits of productivity. In fact, dampens productivity in the aggregate. And that's actually what we saw here in this last reading for the third quarter. And we were expecting some contraction because we knew that we were seeing some slower economic data begin to emerge in the third quarter, but it was a little bit greater than expected. So again, there's some academic fear that negative productivity will provide more feedstock to inflation. Obviously, we have inflation now. I think this number, as you can see in the upper part of this chart page here, that it can be a pretty volatile number. It is rare to see a number this negative. I do think it does reverse itself, and productivity on balance, as you can see in the slide, in the part of this chart down at the lower end, it's continued to trend higher. It's just gone down a little bit here in 2021, but in the aggregate, it's still above this longer term trend, which has persisted really since the beginning of the last decade. Here's unit labor cost, and those are obviously moving higher. We know about that. Lower boundary unit labor costs on a trend line basis, again, kind of along the same lines as the analysis that we saw on productivity being higher than its trend line. We also see unit labor costs trending a little bit higher too. And again, this was beginning to manifest itself really as we were heading into the pandemic anyway, and we saw that kind of a brief dislocation, but the trend line is still moving higher, and the data itself is above that multi-year trend. IT budgets, as we look at capital spending expectations and listening to some of these earnings reports, I mean, there's a lot of optimism on the part of C-suite executives, CEOs, CFOs, COOs, and they're putting their money where their mouth is. So these are 2022 budgets related to information technology, and this is not just U.S. This is a global survey that's put out by Gartner, and it represents a rather strong spike in intentions for spending looking out into next year. And I think this is it shows a lot of confidence in the backdrop of the market. Again, not that the market's can be volatile in spots, and not that the market, can't reverse course and correct briefly. But, on balance, the CEOs feel very confident about what's going on in the economy, and they're planning to spend money to expand their business in the face of it. All right, well, we're going to talk about interest rates a little bit. Now, this is kind of the trend line tracker, if you will, of the probability of a June rate increase by the Federal Reserve. Now, a lot has been made over the last week over the Fed's tapering activity, which just means that they've been buying a lot of assets in the open market and in the dealer market for not only treasuries but also mortgage-backed securities, and they're going to be curbing those purchases to a point where they're going to be essentially not buying any of those instruments on the open market as of the middle of next year, which a lot of people, and we'll see this in a second too, consider to be kind of the launching point for Federal Reserve rate increases of short-term rates. And so you can see that here, that the probability is about 2/3, or about 67% here, that the Fed will have a rate hike by June of next year, or maybe even a little bit sooner. Well, this is the chart that I was referring to before, and so this is kind of that nexus of tapering of asset purchases and the expectation of interest rate increases. And what we're seeing here is a real coalescing of data. So again, it's net purchases of treasuries and mortgage backs, beginning to go down as of now, basically. And so by the middle of next year, the Fed should be out of those markets. And you can see that in the combination of the blue and the black lines, the bars here. But at the same time, in kind of that, that amber line here, that's the effective Fed funds rate, which we know is essentially zero. But then that expectation begins to turn higher, essentially about the same time that asset purchases are ceasing. So what this shows us here is that the market is really confident. The confidence level is really building within the market that June is that trigger point where we not only see the end of the taper, so to speak, but we also see interest rates beginning to move higher. Well, we'll look at the S&P 500 here. On the left-hand side is the index itself. Again, that's nothing new here. We're moving higher in a very kind of deliberate fashion, and we have for quite some time. In fact, it's been almost 500 days since we've seen the S&P 500 clip below its 200-day moving average, and that's depicted for us on the right-hand chart. So we've been essentially 500 days since the S&P 500 went below its 200-day moving average. And so from a market technical standpoint, this is a very strong market. From a relative strength standpoint, which is you can see in that brief yellow highlight on the lower left-hand side of this slide, is that the RSI, the Relative Strength Index, is extremely strong right now. So, again, you could argue that this is a sign of a frothy market, even though price to earnings multiples have come down. We do know that price to sales multiples continue to move higher. So yes, the market, at least from a short-term basis, may be overheated, even though you might be able to make a case for higher multiples because lower interest rates. But when interest rates move higher, it's going to be a little bit more difficult for equities to outperform in that environment, as they have been here to date. And as we can see here, a lot of the movement in the market, at least over the last couple of weeks, with reaching these new highs, has actually been driven by short sellers that are having to cover. So a short seller is expecting to profit when the price of a security falls. And so there's been enough pessimists out there that have gone short on stocks. But when the market moves higher, and moves essentially against their position, they're having to cover the fact that they borrowed securities and sold them. They're covering those to try to stop their loss. And so we've seen the short interest names really pick up steam here over the last week or so. And this is just an indication that you got short sellers covering, which means they're being forced to go buy stock in the market that they wouldn't ordinarily do, but it's helping to push asset prices higher. So as we talked about the overall index itself, I want to take a step back and kind of revisit the whole earnings picture as well, because we're now in the reporting period for the third quarter, and we will be for about another couple of weeks as we receive the last reports here. But you can see here in this trend line on the left, this is the S&P 500 quarterly earnings per share trend line, and the line of best fit is kind of running through all of this. On a blended basis, we are above this trend line. We've had very strong earnings growth by a number of by many industries. In fact, you can see on the right hand side, as you kind of break it down by perhaps size and pretty much by size, the returns on these various indices. If you get down into the smaller cohorts, I mean, in 2020, you really didn't see nearly as strong a response out of the small caps as you did from the large caps, and particularly the mega caps. Now this year, it's been a little bit more interesting. So, as we see on the left-hand side, earnings continue to rise. On the right-hand side, we see that the returns are a bit more equitably dispersed amongst size. So you have 27% for the S&P mega caps, the top 50, but on the same side, you see 27% gain for the S&P small cap 600 as well. Well, in our final slide of the deck this week, I wanted to revisit kind of what I'll call a high frequency indicator. And if you're like me, you kind of look at Starbucks as kind of a rough barometer for the health of the economy. As you can see here, we've in a lot of different areas of the country, we do see an emergence of activity in Starbucks. And this is in particular a study of foot traffic, which we know we're still well below the pre-pandemic levels, which are indexed here at September of 2019. So, really looking over a 2-year window. So in various markets, you're 27, 30% below. In other markets, you're 49, 50, almost 60% if you get into San Francisco. But there's probably no better barometer of what's going on in the real economy than what you see in terms of foot traffic in Starbucks stores. So recovery, but we're still below, well below where we were 2 years ago. Well, that will do it for this week. On behalf of the entire team at BKA Wealth, I hope you've enjoyed this chart pack. I hope you have a wonderful week, and we will talk to you again soon. Take care. Goodbye.